You could be sitting on the biggest missed opportunity of the next decade right now and not even know it. Not because you are not paying attention, not because you are not smart, but because the financial media keeps pointing you toward the same overcrowded trades, the same hyped names, the same companies that already have massive valuations baked in. Meanwhile, 7 stocks, real businesses with real earnings, real cash flow and explosive long-term growth ahead, are sitting quietly with barely any attention at all. That changes today. I went through hundreds of companies to build this list. The filter was simple. Would I be comfortable owning a piece of this business for the next 10 to 20 years? Not trading it, not flipping it when it pops, actually owning it the way you would own a stake in a business you believed in deeply. That question cuts through enormous amounts of emotional noise, and every company on today's list passes that test. If you want analysis built on real numbers and not headlines, hit that subscribe button right now. Let's get into it. Here is what we're covering. 7 stocks the market has either ignored, misunderstood, or temporarily punished for the wrong reasons. 1 is the global transportation platform with 50 million loyal subscribers that the market is pricing like a company in decline. 1 is the travel marketplace generating $4.5 billion in free cash flow from a model that owns 0 properties. 1 is the premium athletic brand growing its shoe business at 26% and its apparel business at 56%, while the stock went down after earnings. 1 is the AI company with the best search engine and the fastest growing cloud platform in the world at a valuation that still makes sense. 1 is the telehealth disruptor growing revenue at 54% annually with a path to $6.5 billion by 2030. 1 is the education platform, down 79% from its highs, while its daily active users keep growing. And 1 is the AI marketing platform that almost nobody in retail investing has ever heard of. I am saving the most overlooked one for last. Let's get into it. Stock number 1 and 2. Uber and Lyft, tickers UBER and LYFT. I want to talk about these together because they operate in the same industry and make sense as a pair. Most investors look at Uber and immediately think about the autonomous vehicle threat. Waymo is on the roads, Tesla is building robotaxis. The fear is that Uber's driver network becomes obsolete. That analysis misses something fundamental about how Uber has actually positioned itself. Uber has successfully diversified into services beyond ride-hailing and is partnering with autonomous vehicle companies, including an order from Rivian for robotaxis, rather than competing against them. Here is the reframe. Uber is not fighting autonomous vehicles. It is building a platform and inviting every autonomous vehicle company to plug into that platform as a supplier. Waymo, Tesla, and a dozen others compete fiercely against each other to win the autonomous vehicle race. Uber sits above all of that and says, plug into our network and access our hundreds of millions of customers. The technology layer becomes a commodity. What does not become a commodity is the customer relationship, the trust, the habit of opening that one app. And Uber owns that. Uber successfully pivoted from chronic losses to a free cash flow powerhouse, while Airbnb remains a victim of its priced-for-perfection IPO. Both currently trail the S&P 500, but their 2026 outlooks depend on distinct catalysts, with Uber's Switzerland of autonomous vehicle strategy being the primary differentiator. The subscription program, Uber One, now has 50 million members, responsible for generating half of all gross bookings. Half. That is a sticky, recurring customer base that makes this business more durable than it looks from the outside. At 22 times forward earnings for a business growing this quickly, the valuation does not reflect that vision at all. Now, Lyft is a smaller version of the same story, about 1/10 the size by active riders, but here is the number that matters. Lyft's forward price to free cash flow is around 5. 5 times free cash flow for a company growing double digits in a duopoly market. The market is pricing Lyft like it is going to disappear. Owning both together is like a basket play on the future of transportation. Here is my honest concern. Autonomous vehicles are a real threat if Uber fails to maintain its platform dominance. And Lyft has significantly less diversification than Uber, giving it less room to maneuver. My takeaway: Uber, at 22 times forward earnings, with 50 million loyal subscribers and the smartest autonomous vehicle strategy in the industry, is one of the most undervalued large caps in the market right now. Lyft, at 5 times free cash flow, is one of the most undervalued small caps. Own both for the transportation revolution. Stock number 3. Airbnb, ticker ABNB. Current price around $130. Most people look at Airbnb and see a travel booking website. They are missing the extraordinary business model underneath. Airbnb operates a global online marketplace connecting property hosts with travelers seeking short-term accommodations, recording a net income margin of approximately 12% for the quarter ended December 31, 2025. Here is what makes Airbnb extraordinary. They do not own a single property, not one. They are a technology platform that connects people with spaces to people who need somewhere to stay. Every time a booking happens, Airbnb takes a fee, and because they own no real estate, they carry none of the debt, maintenance costs, or depreciation that traditional hotel chains manage every single day. Their cost structure is remarkably lean. Free cash flow over the trailing 12 months was $4.5 billion from a model that requires 0 buildings. They received investment-grade ratings from both S&P and Moody's, reflecting how dramatically the balance sheet has strengthened. And here is the international growth that most investors are not pricing in. In India, nights booked grew approximately 50% year over year. In Brazil, over 20% growth for the 3rd consecutive quarter. These are not saturated markets. These are early innings of international expansion happening in real time. The market cap sits around $86 billion. They generated $4.5 billion in free cash flow last year. You are buying this business at roughly 19 times free cash flow. Gross profit margin at 83% means every dollar of revenue they scale drops significant profit to the bottom line. Here is my honest concern. Airbnb has faced headwinds from elevated cancellations tied to global uncertainty, and the stock remains pressured from what was a priced-for-perfection IPO. My takeaway: $4.5 billion in annual free cash flow from 0 owned properties. 50% growth in India. 19 times free cash flow on an 83% gross margin business. This is a long-term compounder that the market is treating like a commodity travel company. Drop a comment right now. Have you ever booked an Airbnb? Because if you have, you already understand why this business has pricing power nobody can replicate. Let's keep going. Stock number 4. ON Holding, ticker ONON. Most investors look at ON Holding and see a shoe company in a difficult consumer environment. They are missing the most important part of what ON is actually building. ON Holding guided for at least 23% growth in 2026. They raised their gross margin guidance, they raised their profitability guidance, and the stock went down after earnings. That is the definition of a misunderstood company. Here is what makes ON different. This is not a budget brand competing on price. Their core customer spends over $200 on footwear. That demographic, higher income households, is remarkably resilient to macroeconomic pressure. And within that demographic, ON has done something most athletic brands consistently fail to do. They have made their products aspirational to women. The majority of high-income household spending decisions are made by or heavily influenced by women. ON markets intelligently to that audience, and it is compounding. The shoe segment has been growing at approximately 26% annually. But here is the part most people miss. The apparel business is growing at 56%, the accessories business at over 80%. These are still small pieces of overall revenue, but they are growing from a small base into potentially significant businesses. When you have a brand that people trust and love, expanding into adjacent categories is one of the most proven ways to extend a growth story for years. Here is my honest concern. On Holdings' premium positioning means any significant economic slowdown affecting high-income consumers could slow growth faster than current estimates suggest. My takeaway: 23% revenue growth guidance with raising margins, 56% apparel growth, and a stock the market punished for doing everything right. At 22 times forward earnings for a brand with this growth profile and runway, this is one of the most straightforward compounders available right now. Stock number 5. Alphabet. Ticker GOOGL. I want to be transparent that this one has run significantly. But even after that run, trading at around 30 times forward earnings, Alphabet remains one of the most compelling businesses on the planet. Search is growing at roughly 16% and actually accelerating. YouTube is growing at 22% annually and remains the most underappreciated streaming platform in existence. Google Cloud is growing at a 40% compounded annual rate. And here is the AI angle that most investors are not fully pricing in. If you believe AI is transformational, but you are not sure which company wins the model race, the chip race, or the application race, Alphabet gives you exposure to all of it simultaneously. They are building their own chips, developing frontier AI models, and they have one of the largest distribution platforms in history for deploying those models. Here is my honest concern. Alphabet carries regulatory risk in both the US and Europe. Any forced breakup of their core businesses would be significant. My takeaway: search accelerating, not decelerating. YouTube growing 22%, cloud growing 40%, and an AI infrastructure bet that could eventually rival the current value of the entire company. Own it and hold it. Stock number 6, Hims & Hers Health, ticker HIMS. This is the highest risk name on this list, and it is also potentially the most asymmetric. The American healthcare system is broken. Finding a doctor, getting a referral, seeing a specialist, submitting to insurance, waiting for approval. Hims & Hers built a direct-to-consumer telehealth model that shortcuts all of it. You describe your issue, connect with a licensed clinician, get a prescription, and it arrives at your door. Faster, cleaner, and in many cases, cheaper. Revenue has compounded at 54% annually over 5 years. They are generating positive free cash flow. Management has a target of $6.5 billion in revenue by 2030. The current market cap is around $5.7 billion. If they come anywhere close to that revenue target, buying the stock today at a $5.7 billion market cap looks in retrospect like an obvious decision. Here is my honest concern. The GLP-1 space faces regulatory risk, and Hims has faced questions about their compounding practices. This stock has been wildly volatile and will continue to be. This is not for conservative investors. My takeaway: 54% revenue growth compounding for 5 years, a path to $6.5 billion in revenue, and a current market cap that already implies the market does not believe they will get there. For investors who can stomach the volatility, this is one of the most asymmetric healthcare technology plays available. Stock number 7, Duolingo, ticker DUOL. Current price around $116. Duolingo shares hit a 52-week high of $540 and a 52-week low of $87.89. The company's market cap stands at $5.29 billion with a PE ratio of 13.18. Most investors see that drop from $540 to $116 and assume something broke. Something did not break. A marketing campaign drove an enormous spike in user growth that created a very tough comparison for the most recent quarter. The market overreacted. Duolingo CEO Luis von Ahn said they made progress on their 2026 strategy, emphasizing speaking as a core learning feature and adding new content while building a product that drives long-term engagement and loyalty. They believe this is what will make Duolingo a much larger and more durable business over time. Here is the strategic evolution most investors are missing. When most people think of Duolingo, they think of learning Spanish on their phone. But Duolingo is becoming a full educational platform. Math is already live. Science and history are expanding. The pace of adding new courses has accelerated dramatically because AI has made course development faster and cheaper. The addressable market when you stop being a language app and start being a platform for lifelong learning is enormous. Every skill you want to develop, potentially delivered through the same gamified behavioral psychology experience that made Duolingo one of the most engaging apps ever built. Duolingo is navigating significant changes in user engagement and monetization strategies, while facing pressure from AI investments. But recent earnings showed strong growth in daily active users. Here is my honest concern. AI-powered language learning tools could reduce Duolingo's competitive advantage if users migrate to conversational AI tutors that provide a more immersive experience. My takeaway: down 79% from its highs on a marketing comparison issue, not a business issue. 13 times PE, daily active users still growing, and a strategic evolution toward a full learning platform that the market has not priced in at all. I would rather own it at 116 and be early than chase it at 300 after the narrative has changed. Let me bring this all together. 7 stocks, 7 companies the market has either ignored, misunderstood, or temporarily punished for the wrong reasons. If I had to rank all 7 for new money today, here is exactly how I see it. Number 1 is Uber, the Switzerland of autonomous vehicles with 50 million loyal subscribers. Number 2 is Airbnb, $4.5 billion in free cash flow from 0 owned properties and 50% growth in India. Number 3 is Duolingo, down 79% for the wrong reasons, with a platform evolution the market has not priced in. Number 4 is ON holding, 23% growth guidance, raising margins, and a stock the market punished for doing everything right. Number 5 is Hims and Hers. Highest risk, highest asymmetry, with a path to 6.5 billion in revenue at a 5.7 billion market cap. Number 6 is Alphabet, the most diversified AI exposure available at a reasonable valuation. Number 7 is Lyft, 5 times free cash flow in a duopoly market. Here is the investing truth I want to leave you with today. The biggest money in any market cycle is almost never made by buying what is already running hot. It is made by identifying strong fundamentals early, buying when sentiment is cautious, and holding while the market catches up to what the numbers are already saying. All 7 companies on this list have fundamentals the market is not fully crediting. That gap between what these businesses are generating and what the market is giving them credit for is the opportunity. Early buyers will look back on these prices and wonder why they ever hesitated. Disagree with any of my picks? Tell me in the comments. Which one would you buy first? Which one do you think is the biggest trap? Subscribe for weekly research on where the real opportunities are hiding before the crowd arrives. No sponsors, no fluff, just the analysis. You can thank me later. See you in the next one.